Let me start with a question that should shake you a little. What if the world's strongest economy is not as liquid, not as stable, and not as untouchable as we were made to believe? Ladies and gentlemen, history does not collapse with noise, it collapses with silence. And right now, the silence in global liquidity is louder than any market crash. Today, I'm not here to spread fear. I'm here to spread awareness, because awareness is power, and power belongs to those who see the storm before the rain begins. Global liquidity has never been a mechanical guarantee. It has always been a psychological contract built on trust, credibility, and expectation. Money does not flow simply because it exists. It flows because people believe it will remain valuable, accessible, and accepted tomorrow. This is the first hook most people miss. Liquidity is not cash sitting in vaults. It is confidence moving at speed. The moment confidence hesitates, liquidity evaporates, even if balance sheets appear strong on paper. History shows this again and again. From currency crises to sovereign debt shocks, liquidity vanishes not when assets disappear, but when belief weakens. For decades, the US dollar enjoyed a unique position as the world's default liquidity provider. Central banks, corporations, and governments trusted that US assets could be sold instantly, funded cheaply, and protected institutionally. That trust created an illusion of permanence. But here is the uncomfortable reality: trust is reversible. When major global players reassess risk, liquidity does not slowly decline, it snaps. The markets don't wait for confirmation. They move ahead of the narrative. This is why liquidity crises always feel sudden, even though they are built slowly over years of policy decisions and structural imbalances. Consider this hook carefully. The global system does not need to reject the dollar for liquidity to tighten. It only needs to question it. When uncertainty rises about debt sustainability, political stability, or long-term monetary discipline, investors demand higher compensation or step back entirely. That pause is lethal to liquidity. Funding costs rise, credit spreads widen, and assets that once traded freely begin to freeze. This process is silent at first, invisible to the public, but painfully obvious to those who live inside capital markets. Liquidity is also asymmetric. It concentrates where trust is strongest and disappears fastest where trust weakens. The US financial system, deeply interconnected and highly leveraged, depends on uninterrupted confidence to function smoothly. When global trust wavers, even slightly, the system feels outsized pressure. This is not weakness by accident. It is the price of being at the center of the global financial network. The more central you are, the more sensitive you become to shifts in belief. Another critical hook is this: liquidity crises are not caused by a lack of money, they are caused by a lack of willingness. Central banks can create currency, but they cannot force trust. Printing money addresses solvency optics, not confidence dynamics. When participants fear inflation, political interference, or long-term value erosion, they hoard liquidity instead of deploying it. This hoarding behavior tightens markets faster than any policy rate hike. Suddenly, everyone wants safety, and safety becomes scarce. Trust-driven liquidity also explains why crises often spread faster than fundamentals justify. Once confidence cracks, markets begin to price worst-case scenarios, not current realities. Liquidity providers pull back preemptively, amplifying stress. This reflexive loop turns minor concerns into systemic events. The danger is not the initial doubt, it is the collective reaction to that doubt. Markets are social systems, and trust is their currency. What makes this moment especially fragile is the scale of dependency on uninterrupted liquidity. Modern economies are built on continuous refinancing, governments rolling debt, corporations funding operations, consumers sustaining credit. When trust falters, refinancing becomes expensive or impossible. Liquidity, once assumed, must suddenly be earned again. That repricing is brutal because it exposes how much growth was fueled by belief rather than productivity. The final hook to understand is this: trust-driven liquidity does not return quickly once lost. Confidence is built slowly and destroyed rapidly. Policy reassurances help, but actions matter more than words. Markets watch consistency, discipline, and credibility over time. Until those signals stabilize, liquidity remains fragile, selective, and cautious. This is why the most dangerous phase of a liquidity crisis is not the panic, it is the prolonged hesitation that follows when trust has not collapsed completely but no longer flows freely. China's reserve and trade strategy represents one of the most underestimated shifts in modern financial history, not because it is dramatic, but because it is deliberate. The real hook is this: global systems rarely break from confrontation, they change through quiet reallocation. China has not announced the end of the dollar era, nor has it attempted to shock markets. Instead, it has methodically reduced dependency on a single currency system that exposes it to external financial pressure. That strategic patience is precisely what makes the impact so powerful. For decades, holding U.S. Treasuries was not just an investment decision for China, it was a necessity of global trade architecture. Export surpluses recycled into dollar assets created a self-reinforcing loop that supported both U.S. liquidity and Chinese growth. But this structure also carried a risk: concentration. When reserves, trade settlement, and financial plumbing are dominated by one currency, economic sovereignty becomes conditional. China recognized that vulnerability early. The shift away from excessive dollar exposure is not an ideological statement, it is a balance sheet decision grounded in risk management. Here is the critical hook most observers miss: China does not need to sell treasuries aggressively to reshape liquidity. Even slowing purchases, allowing maturities to roll off, or diversifying incrementally changes demand dynamics. U.S. Treasury markets are deep, but they are not immune to sustained shifts in marginal buyers. When one of the largest holders becomes less predictable, yields respond, volatility increases, and funding costs recalibrate across the system. Liquidity tightens not because assets disappear, but because certainty does. Trade settlement is where the transformation becomes structural. By expanding bilateral trade agreements settled in local currencies, China reduces the automatic recycling of dollars through its economy. Every transaction settled outside the dollar system is a transaction that does not reinforce dollar liquidity. This is not symbolic, it is mechanical. Over time, reduced dollar turnover lowers demand for dollar reserves, weakens the network effect that sustains dollar dominance, and fragments global liquidity pools. The system becomes multipolar, and multipolar systems are inherently less liquid than centralized ones. Another hook worth understanding is the role of alternative financial infrastructure. China's development of parallel payment systems and cross-border settlement mechanisms is not about replacing existing systems overnight. It is about optionality. Optionality changes behavior. When countries and corporations know they have alternatives, dependency declines. Markets price dependency as stability, but they price optionality as flexibility. Flexibility shifts bargaining power. The U.S. financial system, long accustomed to being the default, now competes for trust rather than assuming it. China's reserve diversification into gold and non-dollar assets further reinforces this shift. Gold is not about yield, it is about neutrality. Unlike sovereign debt, it carries no counterparty risk and no political alignment. Increasing gold reserves sends a subtle but clear signal to markets financial safety is being redefined. That signal influences central banks globally, especially in emerging economies that share similar concerns about sanctions, capital controls, or policy spillovers. Liquidity begins to migrate not toward yield, but toward insulation. This strategy also alters global capital recycling patterns. When China absorbs less U.S. debt, the burden shifts to domestic buyers or other foreign investors, often at higher cost. Higher yields may attract capital temporarily, but they also tighten financial conditions. This is the paradox: what looks like strength in higher yields can mask stress beneath the surface. Liquidity becomes more expensive, more selective, and more volatile. Markets function, but they do so under friction. The most powerful hook is this: China's strategy does not require global coordination to succeed. It only requires consistency. Each incremental adjustment compounds over time, slowly reshaping expectations. Markets adapt not to announcements, but to patterns. And the pattern is clear: China is positioning itself for a world where financial influence is diversified, liquidity is regionalized, and dependence on a single currency is no longer assumed. That shift does not collapse the system overnight, but changes its center of gravity, and when gravity shifts, everything else must rebalance. The sensitivity of U.S. financial markets to shifts in capital flows is not a flaw in isolation. It is the byproduct of scale, openness, and long-standing privilege. The hook most people overlook is this: the strength of the U.S. market has always depended on its ability to attract other people's money. Foreign capital is not a supplement to the system, it is a structural pillar. When that pillar wobbles, even slightly, the effects ripple through equities, bonds, housing, and credit faster than headlines can explain. For decades, the U.S. has operated as the world's preferred destination for surplus capital. Trade imbalances, reserve accumulation, and global savings all found their way into U.S. assets, particularly treasuries, corporate bonds, and equities. This created deep markets and low borrowing costs, reinforcing the perception of safety and liquidity. But here's the critical hook: dependence on inflows creates reflexive vulnerability. When inflows slow, the system doesn't gently adjust, it tightens abruptly. Markets that are used to abundance struggle with scarcity. Capital flows are not static, they respond instantly to risk perception, yield differentials, and geopolitical uncertainty. Even small reallocations by large foreign holders can trigger outsized market reactions. Bond yields rise, equity valuations compress, and the dollar becomes volatile. These are not isolated movements, they feed into one another. Higher yields increase government financing costs, pressure corporate balance sheets, and reduce consumer credit availability. Liquidity stress does not stay contained, it cascades. The hook that sharpens this vulnerability is leverage. U.S. financial markets operate with significant leverage embedded across institutions, funds, and derivatives. Leverage magnifies returns during stable inflow periods, but it magnifies pain when capital retreats. As foreign demand weakens, asset prices decline, collateral values fall, and margin requirements tighten. Liquidity that once felt abundant becomes trapped, locked behind risk controls and balance sheet constraints. The system shifts from risk, taking to risk protection almost overnight. Another dimension often underestimated is the role of foreign investors in price discovery. Foreign capital does not just provide funding, it stabilizes markets by diversifying demand. When that diversity narrows, markets become more fragile. Price movements grow sharper, bid-ask spreads widen, and volatility becomes structural rather than episodic. This fragility is not visible in economic growth data, but it is unmistakable in market behavior. Calm disappears first, stability follows. There is also a psychological hook embedded in capital flow sensitivity. U.S. markets have been conditioned to expect global participation as a constant. When that expectation breaks, confidence erodes internally as well. Domestic investors begin to question whether prices still reflect global consensus or just local optimism. That doubt reduces risk appetite, compounding the withdrawal. Liquidity dries up not because money leaves entirely, but because fewer participants are willing to commit it at prevailing prices. The dollar's role complicates this dynamic further. Capital outflows can strengthen or weaken the dollar depending on context, but either outcome carries stress. A stronger dollar tightens global financial conditions, pressuring foreign borrowers and feeding back into reduced demand for U.S. assets. A weaker dollar raises inflation concerns, forcing tighter monetary policy. In both cases, the sensitivity to foreign capital movements becomes a policy constraint. The U.S. is not just reacting to markets, it is responding to the reactions of global investors. The most revealing hook is this: capital flow sensitivity turns macroeconomic stability into a confidence game. Fiscal deficits, debt issuance, and monetary policy are sustainable only as long as global investors remain willing participants. When participation becomes conditional, stability must be continuously earned. Markets no longer reward scale alone, they demand credibility, discipline, and predictability. What emerges from this dynamic is a system that functions smoothly under trust and strains rapidly under doubt. The U.S. financial market remains powerful, deep, and influential, but its openness makes it highly reactive to shifts in global capital behavior. In an environment where foreign investors reassess risk, diversify reserves, and seek alternatives. Even modest changes in flow direction can reshape pricing, liquidity, and stability in ways that feel sudden, but are rooted in long-standing structural dependence. Liquidity crises never announce themselves with collapsing banks or dramatic headlines. They begin quietly, almost invisibly, long before the public realizes anything is wrong. The most important hook to understand is this: by the time banks fail, the liquidity crisis is already mature. What people recognize as a crisis is actually the final chapter of a much longer story written in funding markets, credit conditions, and institutional behavior that most never see. The earliest signals of liquidity stress appear in places that seem technical and unimportant to outsiders. Short-term funding becomes slightly more expensive. Interbank lending grows cautious. Repo markets demand higher quality collateral. None of this feels like a crisis at first. It feels like prudence. That is the trap. Prudence, when widespread, is the first sign that trust is thinning. Markets do not panic initially, they hesitate. And hesitation is the enemy of liquidity. Here is the hook that separates observers from insiders. Liquidity is about speed, not size. Assets can be valuable, profitable, and solvent, yet still become illiquid. When lenders slow down, even strong institutions feel pressure. Credit lines are not cut immediately. They are shortened, repriced, or burdened with new conditions. This subtle tightening changes behavior across the system. Borrowers delay expansion, investors reduce leverage, and financial institutions prioritize balance, sheet protection over market making. As funding costs rise, risk models adjust automatically. Higher volatility increases capital requirements, forcing institutions to hold more reserves against the same assets. This creates a feedback loop where rising caution reduces market participation, which in turn reduces liquidity further. Prices begin to move more sharply on less volume. This is not because fundamentals collapsed, but because fewer participants are willing to absorb risk. Liquidity drains before fear becomes visible. Another hook lies in the behavior of non-bank financial institutions. Hedge funds, asset managers, and money market funds play a critical role in modern liquidity. When funding conditions tighten, these players reduce exposure quickly to protect investors and meet redemption risks. Unlike banks, they do not have access to central bank backstops in the same way. Their withdrawal accelerates liquidity stress long before regulators intervene. What looks like orderly portfolio adjustment is actually systemic contraction. The real danger emerges when liquidity stress collides with mark-to-market accounting. As asset prices fall due to reduced liquidity, balance sheets weaken mechanically. Collateral values decline, triggering margin calls and forcing asset sales. These sales push prices lower, regardless of underlying value. This is the hook most people miss. Liquidity crises manufacture losses. They turn accounting effects into real damage, even for institutions that were fundamentally sound days earlier. Bank failures, when they finally occur, are not the cause of the crisis, they are the confirmation. By the time a bank collapses, funding markets have already frozen, credit has already tightened, and confidence has already fractured. The failure simply reveals what markets have known privately for weeks or months. This is why bank collapses often come in clusters. They are responding to the same liquidity shock, not creating it. Another critical hook is the role of policy lag. Central banks and regulators act based on data that reflects past conditions. Liquidity stress evolves faster than policy response. By the time interventions are announced, markets have already repriced risk. Emergency measures can stabilize sentiment, but they cannot instantly restore willingness. Liquidity does not return because it is ordered back. It returns when participants believe conditions will remain stable tomorrow. This sequence explains why early warning signs are so often ignored. Liquidity stress does not look dramatic enough to justify alarm. It looks like caution, discipline, and risk management. Only in hindsight does it become obvious that these were symptoms, not virtues. The most dangerous phase of a liquidity crisis is not when institutions fail publicly, but when trust erodes privately and behavior changes quietly across the system. By the time the public sees the damage, liquidity has already left the room. Monetary stability is no longer shaped purely by inflation data, interest rates, or economic cycles. It is increasingly forged in the realm of geopolitics, where financial decisions double as strategic defenses. The first hook to grasp is this: money has become a tool of power, and power always changes how stability behaves. When currencies, payment systems, and reserves are used as leverage, trust stops being purely economic and becomes political. That shift fundamentally alters how liquidity and stability function across the global system. For much of the post-war era, monetary policy operated under the assumption of neutrality. Central banks aimed to stabilize prices and growth, while geopolitics stayed largely outside the plumbing of finance. That separation no longer exists. Sanctions, asset freezes, trade restrictions, and financial exclusions have revealed that access to the global monetary system is conditional. Once that realization sets in, rational actors begin to rethink exposure. The hook is subtle but powerful. When financial infrastructure can be weaponized, reliance on it becomes a strategic risk. This new reality has changed how nations view reserves. Foreign exchange holdings are no longer just buffers against volatility. They are shields against political vulnerability. Countries now ask not only whether an asset is liquid, but whether it is controllable in times of conflict. That single question reshapes reserve composition, trade settlement choices, and investment flows. Liquidity begins to fragment along geopolitical lines, reducing the efficiency that once defined the global system. Another hook lies in the transformation of payment systems. Control over clearing, settlement, and messaging networks has become a source of influence. When access can be restricted, alternatives become attractive, even if they are less efficient. This is how geopolitics quietly drains liquidity. Markets thrive on standardization and scale, but geopolitics rewards redundancy and independence. The more systems diversify for safety, the less liquid the global pool becomes. Geopolitical risk also alters investor behavior in ways that are difficult to reverse. Capital does not flee only from weak economies, it avoids uncertainty. When policy direction appears tied to political cycles, diplomatic tensions, or strategic retaliation, investors demand a premium or reduce exposure altogether. That premium manifests as higher borrowing costs, lower valuations, and tighter financial conditions. The hook here is clear: stability is no longer earned solely through economic discipline, but through political predictability. This dynamic has forced central banks into a more complex role. Monetary policy decisions are now interpreted not just through an economic lens, but through a geopolitical one. Rate changes, liquidity provisions, and currency interventions are scrutinized for strategic intent. This perception matters. When markets believe policy is constrained by political objectives, confidence weakens. Liquidity, which depends on belief in independence and consistency, becomes more fragile. Geopolitical economics also accelerates regionalization. Trade blocs, currency arrangements, and financial alliances form to reduce external exposure. While this provides insulation, it also reduces cross-border capital efficiency. Liquidity that once flowed freely across the globe becomes trapped within regions. The system still functions, but with more friction, less depth, and higher volatility. What looks like resilience on a national level often translates into fragility at the global level. The most underestimated hook is psychological. Once market participants internalize that financial rules can change based on political alignment, behavior shifts permanently. Risk models adjust. Time horizons shorten. Liquidity providers become selective. This is not fear-driven panic, it is rational adaptation. And rational adaptation, when widespread, restructures the entire system. In this environment, monetary stability is no longer a purely technical outcome, it is a strategic one. Decisions made for national security reasons ripple through funding markets, currency values, and asset prices. The invisible hand of the market now wears a geopolitical glove. And as long as financial power and political power remain intertwined, stability will be shaped as much by diplomacy and strategy as by data and rates. What appears to many as a sudden shock is, in reality, the slow unfolding of a structural adjustment that has been building beneath the surface for years. The first hook to recognize is this: Markets are not reacting to a single event, they are repricing an entire era. Short-term shocks grab attention, but structural transitions reshape systems. The current liquidity strain reflects a deeper recalibration in how global capital evaluates risk, safety, and leadership, and that recalibration cannot be reversed with temporary stimulus or reassuring statements. For decades, the global financial system operated under a relatively simple assumption: capital would naturally flow toward the largest, deepest, and most established markets. That assumption created efficiency, scale, and extraordinary liquidity. But it also created concentration. When conditions were stable, concentration looked like strength. When conditions changed, it revealed fragility. The hook here is subtle systems optimized for efficiency are often least prepared for transition. What once minimized friction now amplifies stress. Structural adjustment means that capital is no longer moving blindly toward size, it is moving deliberately toward alignment. Investors, institutions, and governments are reassessing not just returns, but exposure. Exposure to debt sustainability, exposure to political risk, exposure to policy inconsistency. This is not panic behavior, it is strategic repositioning. And strategic repositioning unfolds slowly, quietly, and persistently. Markets feel this as prolonged tightness rather than dramatic collapse. Another hook lies in the difference between cyclical pain and structural pain. Cyclical shocks recover with time and policy easing. Structural shifts demand behavioral change. When global capital becomes more selective, liquidity does not return to its previous abundance, it settles into a new equilibrium. That equilibrium may still function, but it does so with higher costs, lower tolerance for risk, and less margin for error. The adjustment is not temporary discomfort, it is a permanent redefinition of normal. This recalibration forces the U.S. financial system to confront constraints that were previously abstract. Large fiscal deficits, heavy debt issuance, and reliance on external financing were sustainable in a world of automatic demand. In a world of selective demand, every auction, every policy decision, and every signal matters more. The hook here is uncomfortable privilege masked discipline. As privilege fades, discipline becomes unavoidable. Markets begin to differentiate more aggressively between credibility and assumption. Structural adjustment also changes how volatility behaves. Instead of sharp spikes followed by calm, markets experience persistent unease. Liquidity exists, but it is cautious. Capital is present, but it is conditional. This condition-driven environment increases sensitivity to data surprises, policy ambiguity, and geopolitical developments. Volatility becomes a feature rather than a bug. Investors adapt by shortening horizons and reducing exposure, reinforcing the very tightness they seek to avoid. The transition also exposes a mismatch between old policy tools and new realities. Liquidity injections can address immediate stress, but they cannot force long-term commitment. Rate cuts may support valuations, but they do not restore trust once structural doubts emerge. The hook is this: policy can stabilize markets, but it cannot restore the assumptions that once powered them. Those assumptions must be rebuilt through consistency over time. What makes this adjustment especially complex is that it is global, not unilateral. As capital becomes more diversified geographically and institutionally, no single market retains unquestioned dominance. This diffusion reduces systemic risk in theory, but it also reduces liquidity depth in practice. The global system becomes more resilient to collapse, yet more prone to friction. Stability shifts from abundance to balance. Perhaps the most important hook is psychological. Structural transitions challenge identity. Markets, institutions, and policymakers must accept that the old framework no longer applies. Resistance delays adaptation and increases cost. Acceptance accelerates adjustment. The pain of transition is not caused by change itself, but by clinging to expectations that no longer match reality. This moment, then, is not defined by collapse, but by recalibration. Liquidity has not disappeared, it has changed its rules. Capital is still moving, but it now demands clarity, discipline, and alignment. The system is not breaking, it is resetting. And resets are always uncomfortable, not because they destroy value, but because they force everyone to relearn how value is earned. So let me close with this: History rewards those who read signals, not headlines. China didn't trigger a crisis with one move, it exposed a fragile dependency built over decades. And the biggest liquidity crisis in US history is not a moment, it's a transition. A transition from blind confidence to hard reality, from dominance to competition, from comfort to recalibration. The question is not whether the world is changing, the question is whether you are ready to change with it. Because when liquidity dries up, excuses don't matter. Vision does. Awareness does. Action does. And those who understand the game before it's explained, they don't panic. They prepare,